Right, so now let us look at a question from AS 11 on forex fluctuation. Trade receivables as on 31st March 2019 in the books of XYZ Limited include an amount receivable from Umesh rupees 5 lakhs recorded at the prevailing exchange rate on the date of sale. So on that day, $1 is 58.5 and $1 is 61.2 as on 31st March 2019. So transaction happened on a different date. Transaction is being now restated on 31st March, which is the financial year ending. So now what are we supposed to do? Explain briefly the accounting treatment needed in this case as per AS 11 on 31st March 2019. Friends, very simple. First question. There is a foreign exchange item. What is the foreign exchange item? Trade receivables is the foreign exchange item. Clear? Now, trade receivables comes under what category? It comes under monetary items, right? So, it comes under monetary items as per AS 11. If it is a monetary item, then monetary item should be restated to the closing rate. Meaning, monetary item when we sold, it was 58.5. Now it is 61.2. Now at the time of selling we thought we will get 50 at the rate of 58.5, but now we are getting at more value 61.2. So the 5 lakhs what is given in the question is considering what rate? 5 lakhs is considering this rate. Okay, 5 lakhs is considering the rate on the date of transaction. So now you need to do a calculation for 61.2. Come on, how do we do that? If 58.5 represents 5 lakhs, 61.2 represents how much? We can do a simple calculation. So how much will that come to? So that will be 61.2 into 5 lakhs divided by 58.5. So that comes to 5,23,076. Okay. Now 5,23,000 minus 5 lakhs, what was the value at which it was recorded earlier? This 23,076, is it a gain for us or a loss for us? Think about it, is it a gain for us or loss for us? It's a gain for us. Why? When we sold earlier, that is why we have receivables, right? So we sold earlier. So when we sold earlier, we thought we would receive only 5 lakhs. Now exchange rate has gone up. Because exchange rate has gone up from 58.5 to 61.2, we will receive not 5 lakhs, we will receive 5,23,076. That extra 23,076 is not because of my selling price negotiation. That 23,076 is basically a gain that we got on account of foreign exchange fluctuation. So this item should be credited to P&L as foreign exchange gain. Now let us look at the next question, friends. PowerTrack Limited purchased a plant for $50,000 on 31st October 2018. Okay, so this is one important date of purchase. Payable after 6 months. So it is payable after 6 months means start from November, 1st November, 6 months later. So end of April is when it has to be paid. The company entered into a forward contract for 6 months at 64.25. What is that 64.25 called? It is called forward contract rate. What do we call this? This is called forward contract rate. Okay. On 31st October 2018, the exchange rate was 61.50. What is this called? Spot rate. This is called spot rate. Spot rate on the date of transaction. Okay. Then you are required to recognize profit or loss on forward contract in the books of company for the year ended 31st March 2019. Now concentrate carefully, friends. The rate on 31st of October is 61.5 per dollar. When we purchased, we need to pay, right? We need to pay if the entire amount was paid only on 31st of October itself, at what value you would have paid per dollar? Okay, $50,000, keep it aside, per dollar, how much you would have paid? You would have paid 61.50 rupees per dollar, correct? Because we have a commitment to pay after 6 months, my feeling will be, why should I pay now? I'll pay after 6 months. But the problem is, after 6 months, 61.50 could be anything. That is why we actually entered into a forward contract where we said, yes, I know 61.50 is the current rate, but because I need to pay after 6 months, I will pay at 64.25. No surprises for me, it is 64.25. Okay. Now, what is the extra which is being paid per dollar? Extra that is being paid per dollar is forward contract rate minus spot rate, which is 64.25 minus 61.5, which is 2.75 per dollar. Okay, it is per dollar. This is per dollar. How many dollars are there totally? $50,000, right? $50,000 means that will come to rupees 1,37,500. Okay, right. Now, anyway, so some of you must be wondering, sir, how did you quickly calculate 2.75 into 50,000 is 1,37,500? Just if you think through it, 50,000 rupees is the value. Once 50,000 into 2, 1 lakh. If it is into 3, 1 lakh 50,000. So you are reducing in that 50,000 1/4. So I subtracted 12,500. So 1,37,500. Okay. Now 1,37,500 is the cost I have to incur, extra cost I have to incur, because my payment is after 6 months and because I want to make my payment only after 6 months. So I don't want to pay it now. I have time till for 6 months. I want to pay it after 6 months, but I want certainty in how much I am paying. So what is the extra cost I am incurring? 1,37,500. 1,37,500 is the cost for how many months? Is the extra cost for how many months? It is the extra cost for 6 months. Okay, right. Now when I say 6 months, November, December, Jan, Feb, March, April. Okay, so basically the month which is going beyond 31st March is 1 month. Okay, so out of those 6 months, 5 months come into this financial year, 1 month is going into the next financial year. What does the accounting standard tell us? It says that this is a cost, 1,37,500 is a cost for 6 months. In the current year, how many ever months you are kind of exhausting, for those many months cost should come into current period. For the rest, cost should go into the next period. Okay. So how do we do this calculation? For 6 months, if it is 1,37,500, for 5 months, how much does this come to? Come on, let's calculate. 1,37,500 into 5 divided by 6, 1,14,583. Okay, 1,14,583 is the cost which should go and get debited to P&L account as on 31st March 2019. That is what is asked in the question. Recognize the profit or loss for the year ended 31st March 2019. What should go into P&L? 1,14,583 should go into P&L in the current accounting period. Now let us look at the next one, friends. This is a question from AS12, of course from our RTP only. Samrat Limited has set up its business in a designated backward area which entitles the company for subsidy of 25% of the total investment from Government of India. The company has invested ₹80 crores in the eligible investments. The company is eligible for subsidy and has received 20 crores from government in February 2019. Company wants to recognize the said subsidy as its income to improve the bottom line, means profitability of the company. Do you approve the action of the company in accordance with the accounting standard? Okay, let's break it up and check. Samrat Limited has set up its business in a designated backward area. So basically there are some subsidies. How much subsidy? 25% of total investment. Okay, 25% of total investment means 25% of 80 crores, which is 20 crores. So that is the subsidy amount. that subsidy amount has, the conditions are met, it says, right? So received 20 crores also, okay. Then eligible investment, it says. So means conditions are met, and it received 20 crores from government in February 2019. So we are as on 31st March 2019. The money is received in February 2019. Company wants to recognize said subsidy as its income, means it wants to credit to P&L. What is the meaning of income? Credit to P&L. That is what the company wants to do. Okay, right. Now, do you approve the action of the company? Come on, let us go into the first step. Government grant. Can I recognize government grant first of all? Forget how I want to recognize. Can I recognize? Provide. Yes, we can recognize, provided the conditions relating to government grant are met and the collectability is reasonably certain. Okay. So now when you talk about that element, the conditions first, did we meet the conditions? The question says eligible investments. So we are assuming because of that word, the conditions relating to government grant are met by the company. Then receivability is the second condition. The question says, receivability hai and it's even received, okay, right. If it is simply received, we cannot conclude, but conditions are met and also it is received. So question says there is no question, it's a government grant only. So now we are clear, it is our government grant, okay, there is no confusion, it is our government grant. It requires recognition somewhere, okay. Now, where should that recognition happen? Okay, ask yourself this question. Is it for a specific fixed asset? Is it for a specific fixed asset? No, it's not for a specific fixed asset. The company has set up a factory or its business in a rural or some backward area. So there is no, it's not for specific fixed asset. For your godown or cold storage unit, we are giving this much of subsidy. No, it's not that. It is more for the investment made, not specifically attributable to a fixed asset, okay, right. So in that total, there must be some fixed asset also, I am not denying that, but the way the government grant is structured, it is not only for that cold storage machinery, no, it's not that, it is for business as a whole. That is the important point you need to know, okay, right. So that is why you can't discuss the considerations of fixed asset, okay, forget it. Now come to the next category. Is it more in the nature of income? Well, this is not really in the nature of income, this is more in the nature of promoter's contribution, what we learnt as a part of accounting standard 12. Why do I say it's a part of promoter's contribution? The promoters or the company is not doing anything new, is basically not going to incur anything new in the future, or is not expected to fulfill any conditions in the future. I think that's a better way to put it. The company is not expected to fulfill any conditions in the future requiring outflow of resources for it to get this grant. So this grant is not linked to any revenue outflow or any P&L related outflow the company is going to have in the future, okay. So this is more in the nature of promoter's contribution. Company doesn't really have to do anything specific in the future for it to get to this grant. So that is why this grant is straightforward case of promoter's contribution. If a grant is in the nature of promoter's contribution, it should be credited to capital reserve. Correct? We learned this. And the company wants to credit it to income. No, it can't. In fact, once you credit it to capital reserve, you cannot transfer that capital reserve to P&L account. So it cannot be used for distribution as dividend. So just because company wants to improve bottom line, means profit, company cannot simply transfer this capital reserve to P&L or anything like that. This has to be transferred to capital reserve and it should remain in capital reserve only. Okay. And of course, how capital reserve can be utilized is a different discussion. Okay. The purposes for which capital reserve can be utilized is a different discussion. So I'm not going into that. So company cannot transfer it to income. Transfer or recognize it as income as is given in the question. It should be that amount 20 crore should be credited to capital reserve. Friends, I have just been discussing the gist of solution. The way to present answers for accounting standard questions, I have already discussed in detail as to how you should do it. We have a separate video for that, particularly in examinations, how should you approach accounting standard based questions. So you can refer to that video, in relation to the presentation aspects of the answer. Right, now come to accounting standard 13 related question, investments of course. Z Bank has classified its total investments on 31st March 2018 into 3 categories: held to maturity, available for sale, held for trading as per RBI guidelines. Held to maturity investments are carried at acquisition cost less amortized amount. Available for sale investments are carried at mark to market. Held for trading investments are valued in weekly intervals at market. Net depreciation, if any, is charged to revenue, and net appreciation, if any, is ignored. You are required to comment whether policy of bank is in accordance with AS 13. I would actually call it a trick question, because as per AS 13, the investment accounting discussed as per AS 13 is not applicable to banks, insurance companies, mutual funds, etc. So this is a bank, it's a Z or Z bank. So you can't apply general principles of AS 13 to investments that you have in bank. In fact, for banks, RBI has given separate guidelines for investment related accounting. So you cannot apply the regular provisions of AS 13 for banks. So this treatment of AS 13 is not applicable. Special treatment or specific treatment given by RBI will be applicable. Now let's look at a question from AS 16, borrowing cost. In May 2018, Capacity Limited took a bank loan to be used specifically for construction of a new factory building. The construction was completed in January 2019 and the building was put to its use immediately thereafter. Interest on actual amount used for construction of the building till its completion was 18 lakhs, whereas total interest payable to bank on the loan for the period till 31st March 2019 amounted to 25 lakhs. Can 25 lakhs be treated as part of cost of factory building and thus be capitalized on the plea that loan was specifically taken for the construction of factory building? Explain the treatment in line with provisions of AS 16. Now, friends, let's take the first aspect of the question. This is regarding borrowing cost. Borrowing cost is only for qualifying assets. We know that as per AS 16. What is the meaning of qualifying asset? An asset which takes substantial amount of time to get ready for its intended use or sale. Okay. Now, what is substantial? We said substantial is something that company defines. Substantial, if company doesn't define, probably could be 12 months, but company can decide even 6 months to be substantial. Okay. It is basically a thing that the company can decide. Clear? Now, in this given case, first of all, is this asset called factory building a qualifying asset? To answer that, we should say that, hey, company does the policy, the question is silent about whether company's policy allows this to be a qualifying asset or not, given the company's policy regarding substantial period. However, we can write a note and state that as per the company's policy, it is assumed that company has a policy for this asset to be qualified, to be considered as a qualifying asset for the purpose of AS 16. Okay, let us assume that there is a policy like that. So this became a qualifying asset. So your assumption made this asset into a qualifying asset. Otherwise, what will happen? Otherwise, you will say, if your assumption is this is not a qualifying asset, then your answer will be not a qualifying asset, entire 25 lakhs debited to P&L. Now, examiner really wants to test you on something deeper than just saying I am assuming that it is not a qualifying asset, so entire thing is debited to P&L. So examiner is not trying to test you on that. So our assumption should also be relevant to the thought process of examiner to the extent possible. Okay, so here we are considering this asset to be a qualifying asset. Okay, right. Now move to the next step. If it is a qualifying asset, when do you start the capitalization? You don't have to explain all those points, but you know when you have to start the capitalization. I'm not talking about you writing these in the examination, I'm just discussing that. So you have to be sure that the work relating to that has started, then the loan has been taken and that loan has been applied for the purpose of construction of this qualifying asset and so on. Okay, right. Then till what time? The important point in the question is regarding that. At what point should capitalization cease? We have this as a topic called as cessation of capitalization in AS 16. Cessation of capitalization says that this qualifying asset should, the capitalization on this qualifying asset should cease once the qualifying asset is ready or substantially ready for its intended use. Ready or substantially ready for its intended use. In our given case, when was this qualifying asset ready for its intended use? Completed in January 2019. Okay, in January 2019. Now, till that time, till its completion, interest was 18 lakhs. Okay, right. Let's understand this carefully. Loan was taken in May 2018. There is 31st March 19. Interest for this entire period is 25 lakhs. Then, if you take Jan 2019, that is the date of completion, in this period interest is 18 lakhs. That is the question. Meaning, in this period interest is 7 lakhs. Till completion 18 lakhs, after completion before year end 7 lakhs. That is what the question says. Now, once the asset, qualifying asset gets ready for its intended use, completed means what? It's ready for its intended use, right? Otherwise you can't say it's completed. So if the asset is ready for its intended use, capitalization of borrowing cost should cease, means permanently stop. So after this period, you cannot capitalize the interest cost. Now, what about 18 lakhs? 18 lakhs can go and get capitalized. Okay, it can get capitalized to the asset. This 7 lakhs should be debited to P&L as interest. That's all. It's an interest borrowing cost. It should be debited to P&L. Now let us look at the next question. It is regarding AS 17 segment reporting. A company has an inter-segment transfer pricing policy of charging at cost less 5%. Market prices are generally 20% above cost. You are required to examine whether the policy adopted by the company is correct or not. Friends, the good or bad thing with accounting standards is this. A 5 marks or 4 marks question, you will be sure of those 5 marks or 4 marks if you have studied. There is no way you can attempt it if you haven't studied. And the reason why we emphasize a lot in Indigolearn on accounting standards is the success of student depends heavily on accounting standards, because it's easy. One, it's easy to score marks, it's easy to get full marks, and you can also solve it in a very time sensitive manner or a time conscious manner, because it's not really long and elaborate. It's pretty crisp and to the point. Okay, now let's look at this question. AS 17, company has an inter-segment transfer pricing policy. Okay, say there are 3 segments. Segment A, segment B, segment C. Segment A is transferring to segment B. Let's just put it down. There are 3 segments, A, B, C. Transfer pricing policy of charging at cost less 5%. Say cost is 100 minus 5, at 95 segment A is transferring to segment B. Market prices, if segment A were to sell this to outside market, segment A would have sold it at 120 is what it says. Okay, that's the point. You are required to examine whether policy adopted by the company is correct or not. Friends, the accounting standard says that inter-segment price, right? This inter-segment price can be same. Whatever is the 100 cost we have, it can be at same 100. It can be at a discount. Basically, there can be a concession, or it can be at market price or any other price. It is an internal transfer. It can be at any other price. There is no problem. But what is the important element? The important element, the examiner trapped you by, try to trap you at least. You people will not get trapped. Try to trap us by saying, hey, cost is 100. How can I transfer it 95? Come on, all our answers. No, it can't be possible. We shouldn't do it. Wrong. Like this, we'll write answers. That's not exactly what you're supposed to do. The way you need to understand this is, accounting standard never prohibited intersegmental transfer pricing policy of the company. It said, oh, 100 is your cost. Transfer at 100 if you want. 100 is your cost. Transfer at 120 if that is the market price. 100 is your cost. Transfer at 150, which is more than your market price. Transfer at 110, we don't care. Transfer at 90, we don't care. You get that point? So, accounting standard does not prohibit or restrict the price at which the transfer price should be done. That is the first thing. However, accounting standard simply says disclose. What is the transfer pricing policy you applied? Just disclose. Oh, I'm transferring at 5% discount. Disclose. I'm transferring at 20% premium. That is higher profit. Disclose. Whatever you are doing, disclose is all that accounting standard says. In fact, segment reporting itself is only disclosures. It has nothing to do with accounting. By reading segment reporting, there is no accounting we do. Second, in segment reporting also, we do not have to worry about the price at which this transfer pricing is happening. We just need to ensure that disclosures are clear and comprehensive. That's all. Okay. So, the straight answer, is the policy adopted by a company correct or not? Yeah, it is correct. There is no problem with the policy adopted by the company. Now, let us look at one question. It's an interesting question, an important question from AS 22 on deferred taxes. The accountant of Sona Limited provides the following information for the year ended 31st March 2019. Accounting profits, book profits as per MAT, profit as per Income Tax Act, tax rate, MAT rate. You are required to calculate deferred tax asset or liability as per AS 22 and amount of tax to be debited to P&L account for the year. There are two aspects that are asked in the question. Let us take one by one. The first aspect is calculate the deferred tax asset or liability as per AS 22. First, we will focus on that. Deferred tax. Deferred tax means there is a timing or temporary difference between the tax liability as per accounting and tax liability as per income tax. That is when deferred tax comes, right? Now, the accounting profits are 7,50,000. So, as per accounting, purely accounting, we would have said on 7,50,000 we should pay 20%. The income tax profits are 90,000. Okay. Here we would have probably said on this we should pay 20%. So, because the accounting profits are more and income tax is less, if we say that this is giving rise to a timing difference, first of all, ignore the tax rate also for a moment, okay. If the 7,50,000 and 90,000, if this difference is only because of timing difference, so what is this amount? This amount is 6,60,000. If 6,60,000 is on account of timing difference, if 6,60,000 is on account of timing difference, then I will say 6,60,000 into future applicable tax rate. Okay, so what is the future applicable tax rate as per our best estimation? So let's calculate. We don't have any other number, so we'll calculate at 20% only. At 20%, 6,60,000 into 20%, 1,32,000 is the deferred tax. Now, is it a deferred tax asset or a liability is the next question. Now, as per income tax, our profits are less. If this 6,60,000 is assumed to be timing difference, I am repeating, if it is assumed to be timing difference, then only deferred tax discussion comes. If you write a note, assumed that 6,60,000 is permanent difference, then 0 is the deferred tax. Understood? So, don't make an assumption, as I said, which will oversimplify your problem, because examiner's intention will definitely not be that. Okay, right. So 6,60,000 into 20%, 1,32,000 is the deferred tax. Now we are basically saying we are saving now where we might pay later. So this is deferred tax liability. This is deferred tax liability. Okay. So this is deferred tax liability means yes, it will go and get credited to liability, means credited to liability, debited to where? P&L. It will be debited to P&L. So in P&L, this 1,32,000 also will get debited. Are we clear about this? So the first part of the question, which is regarding deferred tax, we are now clear. Deferred tax as on 31st March 2019 will be 1,32,000. Deferred tax liability will be 1,32,000. Okay, right. Now let's move to the next aspect. What is the amount that will be debited to P&L? We will consider three aspects in our P&L. What are the three things we should consider? Our regular income tax is, profit is 90,000. 90,000 into 20% tax rate will give us 18,000 rupees. Okay, 90,000 into 20% tax rate will give us 18,000 rupees. Will 18,000 rupees go into the P&L? To answer that, we should also calculate MAT. What is MAT? Profit for MAT, book profit for MAT is 4,37,500. There is a special section in income tax for MAT calculation that you will learn as a part of your tax subject. 437,500 into, say, what is the MAT rate given in the question? 7.5 is what is given in the question, so 7.5%. Let's calculate. 4,37,500 into 7.5%, 32,813. I'll just round it off, okay? 813 I'll call it. 32,813. Now, the simple thing that you need to know is you will calculate book profit as per MAT, and on that you will apply the MAT rate and arrive at a tax amount. You will consider the profit as per income tax, apply the income tax applicable rate of 20% and arrive at the tax amount. You will consider greater of the two to go into P&L. You will consider greater of the two to go into P&L. So greater of the two, why do you consider and all? Detailed discussion you will have as a part of your income tax as to why it is being done, etc. But the accounting principle behind that is you will consider the greater of the two. Okay. So greater of the two means which one will you consider? You will consider this one to go into P&L. Okay. Now if 32,813 is what is going into P&L. Already deferred tax of 1,32,000 we said will get debited to P&L. So now calculate 1,32,000 plus 32,813 put together 1,64,813, which will be debited to P&L. That is what will happen. That's all. Okay. So friends, these are the questions which are given in RTPs in relation to accounting standards. But as I said, do watch the video that I made on accounting standard related presentation for the examination purpose.